everyone. Yes, we experienced a small technical issue just now, but everything is functioning smoothly again now. Thank you.
So, as you can see today, I'm delighted to be welcoming back a familiar guest once again. It's Casta from Evergrande Investment. Hey, it's truly been quite a while since I last had the pleasure of seeing you, and I really wanted to take this opportunity to catch up with you and hear all about what you've been doing lately. Before we proceed any further, I would like to request that Ryan provide me with a detailed overview of the current analysis and insights regarding the Hong Kong stock market. Understanding the latest trends and fluctuations in this specific market is crucial for making informed decisions moving forward.
Then I'd like to kindly ask Casta for a detailed update on the current situation. If I remember correctly, the last time you were here was around the middle of last year, correct? Back when the S&P 58 was at 390, we had a very good chat about various topics.
Next month, we will have even more interesting topics to discuss, correct?
Absolutely, that's correct. We certainly will.
Oh, it seems there's a problem with my phone. Sorry about that. Today, the index is at 23,483, up by 139 points. I believe my phone has not yet completed its software update.
The app seems problematic, so I'll uninstall it.
Absolutely. I need to utilize the company app for our analysis. Let's take a closer look at the performance of the Hang Seng Index today and find an available colleague or expert to discuss its implications and insights further. Today, I distinctly remember that the stock market initially dropped significantly in the morning, causing concern among investors. However, as the day progressed, it rebounded quite impressively in the afternoon, leading to an overall positive trend as the market picked up momentum and improved throughout the day.
However, it still hasn't managed to cross above the crucial 20-day moving average, which is somewhat concerning for investors and analysts alike. The 20-day moving average has consistently proven to be a reliable indicator of trends since January this year. However, we have observed its struggle to consistently maintain that elevated level in recent days, indicating potential challenges or fluctuations that may impact its stability and performance moving forward. The primary reason for the noticeable decline in the 20-day average is attributed to the recent volatility observed in this upward trend. Therefore, it is essential that we closely monitor this situation to understand any potential implications for future performance and to make informed decisions moving forward. The trading volume tonight is approximately 200 billion, which is just shy of the 1900 mark. Consequently, I'm feeling a bit concerned that there may not be sufficient momentum to drive the market forward as expected. We've been eagerly waiting for one significant thing, which is that the index's upward trend since January has been primarily driven by the influx of northbound capital investments. Everyone is currently discussing the anticipation surrounding the potential influx of foreign capital into the market, which could effectively drive Hong Kong stocks higher. However, it appears that these investors are exhibiting some reluctance to make their move, perhaps due to uncertainty or a strategy of waiting for prices to decrease before committing to their investments. This hesitation is creating a cautious atmosphere among market participants who are closely monitoring the situation for any signs of change. Once we reach these specific levels, we might need to consider taking profits. However, I believe that instead of simply cashing out, it would be more appropriate for us to adjust our current positions and make some strategic deployments to maximize our potential gains in the long run. This approach may help us capitalize on future opportunities more effectively.
At this moment, there are no evident buying opportunities or high-yield positions available in the market. I believe this is primarily due to the absence of any significant news regarding the return of foreign capital, which typically plays a crucial role in market dynamics and investor confidence. Until we see developments in this area, prospects for attractive investment options remain limited. However, there is still a significant amount of northbound capital that is helping to keep our Hong Kong stocks afloat. And we are observing some overseas funds engaging in net buying activities, particularly in sectors such as the internet and semiconductors, which is a positive sign for these markets. Also in automotive, consumer electronics, and healthcare, which are core sectors. Do you believe that these specific sectors are worth paying close attention to as potential areas of growth and opportunity in the future?
Today, in addition to discussing Hong Kong stocks, the technology index is also a significant focus of attention, and we are observing overseas investment funds purchasing a substantial amount of technology-related stocks as well as automotive stocks.
So we need to remind everyone why we should pay attention to these indices. Recently, there has been a significant focus on investment strategies that prioritize key financial products, particularly the tracker fund and its related exchange-traded funds, ETFs, which have gained popularity among investors seeking diversified options in the market. We should particularly highlight e-bonds, as they serve as a significant representative of the current investment landscape. If substantial funds are entering the Hong Kong market, one can easily imagine the types of securities and investments they would likely choose to acquire. They would definitely seek out unique items that are not readily available overseas, and secondly, they would focus on investing in mainstream and heavyweight stocks. These are likely to be robust and reliable stocks that we are well acquainted with and have studied thoroughly. Yes, strong stocks typically show initial gains followed by later losses. They are also components of these indices. I believe that these indices actually serve some important indicative or functional roles within the context they are used.
I just mentioned that Kesta actually peaked last year around the middle of the year after reaching an impressive value of 390.5, and it hasn't been seen in the market since, which is almost half a year now. Recently, what developments have been occurring with Hang Seng Investment? Additionally, are there any specific funds or ETFs currently available that investors should consider exploring?
Let's refresh everyone's memory. Hang Seng Investment is the ETF issuer, and the most familiar ones are the Tracker Fund and the Hang Seng China Enterprises Index ETF 2828. And please don't forget to consider we also have the Hang Seng Tech Index ETF, which is identified as 3U32. Last year, we successfully launched 4 innovative new ETFs, which included a fund specifically targeting US stocks, the well-known S&P 500 Index ETF, and another focused on Japan's prominent Topics 100 Index, in addition to 2 US Treasury ETFs. We currently have a total of 13 exchange-traded funds ETFs, and we are committed to continuing our programs and sharing insights with everyone. Our goal is to develop and offer a product that is well suited for investors looking to effectively deploy their capital.
Yes, and in my personal life, I have several friends who, in fact, really don't invest in individual stocks, but prefer to focus on mutual funds or other investment options instead.
They truly invest in ETFs. It is widely understood that over the past few years, the 2800 index has indeed shown a positive return. However, due to the significant influx of northbound funds at the beginning of this year, several investors have informed me that they have purchased a small amount of the 2800 index, viewing it as a strategic method to engage in trading and invest once more in the current market landscape.
However, regarding the investment of 2800, since you initially invested in the Hang Seng Index in 2022, you have also established several RMB trading counters. Additionally, you have made necessary adjustments to the management fees and trustee fees, which are important considerations that everyone is concerned about. Your efforts aim to enhance overall investor satisfaction and transparency.
After implementing these significant optimizations, how has the overall performance of the 2800 system been? Well, in terms of the 2800's operational efficiency, it clearly demonstrates that the annual recurring expense ratio is impressively low at just 0.07%, indicating sound financial management. So it can be said that it's the cheapest ETF tracking the Hang Seng Index in Hong Kong. So we at Hang Seng Investment, after taking over the Tracker Fund in September 2002, have seen its daily average trading volume reach 10 billion HKD, which is more than 3 times what it was 5 years ago. You may have noticed that the Hong Kong stock market hasn't been particularly impressive or strong in recent years, but the size of the Tracker Fund has consistently increased and grown, primarily because we have been very proactive and strategic in our investment approaches. We have been actively engaging with a variety of investors to share relevant information and are dedicated to expanding this ETF into promising overseas markets, including the Middle East and Southeast Asia regions, to tap into new opportunities. Speaking of the dynamic Middle East market, I noticed that last year, specifically on October 31, we successfully launched a locally listed exchange-traded fund, ETF, in collaboration with a reputable local asset management company in Saudi Arabia known as SAB Invest. This initiative was aimed at enhancing investment opportunities for local investors. This locally listed exchange-traded fund, ETF, is fully and entirely invested in the Tracker Fund, with its primary objective being to offer Middle Eastern investors a reliable and efficient channel to gain access to the diverse opportunities within the Hong Kong capital market. Currently, this local ETF has an asset size of about 500 million USD, which is around 4 billion HKD. While our current size remains quite modest, we are committed to actively expanding our overseas business operations, particularly in Saudi Arabia and various other locations. Our goal is to successfully bring the Tracker Fund to a broader audience of investors, enhancing their investment opportunities. This way, we can reach more investors outside of Hong Kong.
There's still a significant amount of growth potential to explore.
Yes, that's right.
As you know, funds in the Middle East are quite abundant.
Speaking of Middle Eastern funds, I would like to ask Ryan a question. Coming from a perspective that might not traditionally be associated with the financial sector, my knowledge is limited to just Arabic numerals. I would like to ask you about this topic, as it seems everyone is discussing how the Hong Kong government is aiming to attract some Middle Eastern investment funds or establish family offices.
However, the central issue lies in the fact that due to significant cultural differences or potential language barriers, do you truly believe it is exceptionally challenging to facilitate their relocation here in order to establish offices or to make substantial investments?
Now, Tencent has strategically invested in an exchange-traded fund, ETF, that can effectively cooperate on a local level, but is it genuinely as difficult as it seems to persuade them to come and establish offices?
Actually, you asked a very insightful question. To be completely honest, from a cultural perspective in Hong Kong, if you aim to attract not only funds from the Middle East but also talented individuals and substantial financial resources, the competition you face is incredibly intense and challenging. This landscape requires innovative strategies to stand out and succeed amidst numerous other contenders. When you travel southward, you will encounter at least two significant Islamic countries, Malaysia and Indonesia, both known for their rich cultures and traditions. Additionally, Singapore serves as another prominent center for asset management, and we frequently find ourselves competing with them in this sector. Their deep familiarity with the Islamic world and its dynamics is certainly stronger than that of Hong Kong's. Certainly, here's an expanded version of the original text. So, regarding local personnel, let's not even begin to discuss the complexities of language barriers. When they arrive in Hong Kong to live and work, they often find that the surrounding community and its amenities are not very convenient or accessible for their everyday needs. However, when discussing the Hang Seng, it's important to note that this specific type of pod represents yet another innovative form of investment. Essentially, they establish a local ETF or exchange-traded fund to effectively attract and channel additional capital into Hong Kong's vibrant stock market, thereby stimulating growth. They don't need to wear face coverings. In Hong Kong, there aren't many poor quality restaurants or sufficient prayer spaces available, which doesn't significantly impact their investment decisions. There are indeed two important aspects to consider in this context. This situation largely depends on various geographical factors and diverse cultural backgrounds, which ultimately allow you to effectively leverage your unique strengths. Competing directly with Islamic countries, however, is honestly not feasible given the complexities involved.
Now let us shift our focus back from the rich Islamic context to our perspective on artificial intelligence. While the virtual world may appear unusual and unfamiliar to many, I would like to highlight an important financial development. The Hang Seng Index, which is a key indicator of the stock market in Hong Kong, actually experienced a rise in value during February of this year.
It surged significantly in the market due to the sudden emergence of specific trends that captured consumer interest. Yes, and following that, the emergence of dissidents indicates that the attitude of foreign capital towards investing in Chinese tech stocks has experienced a slight shift. This change is largely due to the fact that developing an advanced AI model can now be accomplished at a significantly lower cost than before, making it more accessible for a wider range of investors and companies.
Yes, various AI models, along with several international investment funds, have strategically shifted their focus from US stocks and have redirected their investments back into our Hong Kong stocks, specifically targeting those that are trading in authentic AI-related companies, and also in A-shares.
Additionally, I recently came across a comprehensive survey from Bank of America stating that the Hang Seng Index is projected to become one of the best performing financial markets globally by the year 2025.
Given this informative background, do you believe that the investment value of our Hong Kong Technology Index can be effectively reassessed? First, I would like to know your thoughts on this matter. Secondly, if we break down the index further, which specific sectors or individual stocks should we prioritize and focus on more intensely for potential investment opportunities? Your insights on these questions would be greatly appreciated as we consider our strategy moving forward.
Let's have a conversation about this topic in a broad and general manner. Sure. Hey there, if you had some extra funds available, which specific stocks would you choose to invest in? How would you assist in restoring the valuation of the project? For them, the crucial aspect of an AI model's effectiveness isn't solely based on its fluency or language capabilities, but also on its accuracy, reliability, and the value it adds to decision-making processes. It's about whether it can effectively compete with existing models in the market or possess corresponding reasoning capabilities that allow it to make sound judgments and decisions. Now, we all know that DeepSet excels remarkably in logical reasoning tasks, and its ranking is consistently comparable to that of the leading AI models in the industry, showcasing its advanced capabilities and performance. Well, everyone knows that their access fees and training costs are significantly lower compared to existing models on the market, which gives a sense of hope for more people to participate and benefit from this opportunity. If this approach can be effectively applied at the enterprise level, you will achieve both increased speed and enhanced efficiency in operations and processes. These hopes are primarily focused on benefiting large enterprises in various industries. The most applicable scenarios for artificial intelligence in monetization typically involve larger enterprises, which helps to explain why certain stocks can experience significant increases in their value before others. These larger companies often have the resources and data necessary to effectively leverage AI technology for improved financial outcomes.
Regarding the topic of AI, there were significant concerns raised yesterday that both of you should have closely observed concerning Alibaba and Daniel Zhang. They announced some important information stating that Alibaba plans to invest a substantial amount of 380 billion in various sectors over the next 3 years. This substantial amount of 380 billion yuan will be allocated specifically to enhance and expand their AI capabilities and cloud infrastructure, which is noteworthy as it surpasses their cumulative total investment made in the past decade combined. Daniel Zhang also noted that some individuals within the market may interpret this information in a somewhat distorted manner, or perhaps even from a slightly off-angle perspective. When he casually mentioned the word bubble, a wave of curiosity swept through the audience, prompting people to start wondering and speculating if the realm of artificial intelligence, often referred to as AI, is experiencing a bubble phenomenon similar to those seen in other sectors of the economy. This sparked discussions about the sustainability and future trajectory of AI investments and innovations in the current market landscape. Alan believes that at this moment, the AI industry could be experiencing some overcapacity challenges which may affect market dynamics. In light of this, Zhou is making a substantial investment of 380 billion yuan into AI technology and cloud computing infrastructure. Meanwhile, in the United States, discussions are underway regarding investments reaching $500 billion or potentially even higher amounts, reflecting significant financial commitment to the sector. He strongly believes that it's simply not worth the effort or resources. How would you evaluate the present investment outlook for artificial intelligence in China?
Zhou Tsai, as the vice chairman of Alibaba, wouldn't openly discuss whether Alibaba is overinvesting. Also, Alibaba's capex is around 380 billion yuan, which is not a small amount for the next 3 years. I believe that whether there is a bubble in artificial intelligence or its various applications really depends on how effectively it is utilized and whether there exists a viable monetization potential. You need to find a company that possesses both a well-developed scenario and a sophisticated AI model, and there are relatively few such companies among the publicly listed firms located in Hong Kong that meet these specific criteria. Moreover, you also have to consider the major stocks in the Hang Seng Index and the Tech Index. So honestly, if Hong Kong stocks can adjust appropriately now and then rise again after this challenging period, it would be a promising sign for investors. Tech stocks are essential for the market. Large technology stocks are indeed a significant catalyst for driving the index upwards, influencing overall growth.
Currently, the tech index stands at 5,073 as of today. In relation to the Hang Seng investment, it's widely recognized that they have recently announced an exchange-traded fund, ETF, identified as 3032. This particular ETF is part of the Hang Seng Index, which is specifically linked to the Hang Seng Tech Index, a financial indicator that closely monitors and reflects the performance of our tech index.
You can also observe that, in addition to its digital stocks, a number of eye-catching stocks specifically related to the burgeoning field of AI development have already been incorporated into the portfolio. After the recent diss track release, I'm curious about how the market is responding and reacting to this 3032 situation and its implications for trends.
Yes, in the past 3 months, the AI sector has experienced a significant surge, positively benefiting major companies such as Alibaba, Xiaomi, and Tencent. This growth has also noticeably enhanced investor sentiment towards Chinese tech stocks, both on a local scale and in international markets. This surge has driven the tech index up significantly by approximately 28.5%. Some financial analysts forecast that around 61% of the components within the Hang Seng Tech Index are likely to benefit, either directly or indirectly, from the rapid advancement of AI development in China. Wow, hot for 10%. Naturally, everyone can easily continue to follow Ryan to keep an eye on tech stocks and market trends. But at this time, it's also necessary to emphasize the benefits of ETFs and index investing, because under these fluctuations, using ETFs for partial allocation or asset allocation can be very helpful. It really is very helpful. Honestly, not everyone is skilled at accurately timing the market fluctuations effectively. And who has that much time to analyze each stock? Time is also a very important factor. Additionally, as mentioned earlier, the tech index has risen about 28.5% since the beginning of the year, and it has even outperformed the Nasdaq 100 and the Nasdaq Composite Index. Currently, the Chinese tech stocks listed in the US market are trading at approximately a 35% discount, which makes them very attractive for potential investors. Therefore, we firmly believe that the current upward trend of technology stocks this time around will be significantly more sustainable than the policy-driven surge we witnessed last September. Additionally, we anticipate there will be further investment opportunities emerging as we closely observe the capital flow in the market.
The Hang Seng Tech Index ETF 3032 is certainly poised to be a significant focal point for investors moving forward, particularly unless you are choosing to overlook Hong Kong stocks or if there happens to be a widespread and substantial withdrawal of investment funds from the market.
If not, technology stocks will still remain the primary focus of investors, or you may need to hold them for a longer duration to see significant returns. Additionally, if you are considering making an investment, particularly in technology, it is important to note that sectors related to artificial intelligence, AI, will require time to fully develop and mature before yielding substantial results or profits. Patience is essential for anyone looking to navigate this evolving market successfully.
Now, as we can clearly see displayed on the screen, in relation to Hong Kong stocks and A shares, Hang Seng Investment proudly offers 3 flagship products specifically designed for Hong Kong stocks, which notably includes the well-known Tracker Fund among them.
It closely tracks the performance of the Hang Seng Index, and the most recent dividend yield is approximately 3.2%. The total fund size currently stands at a significant 150 billion HKD, and the average trading volume recorded over the past 30 days is roughly 11 billion HKD, indicating robust market activity and investor interest in this fund. The latest dividend yield is about 3.1%. The GM payroll is about 29.7 billion HKD. The average trading price in the last 30 days is around 7 billion HKD. So finally, regarding the Hang Seng Tech Index ET3032, the annual recurring expense ratio is about 0.68%, and the GM scale is quite decent at 5 billion HKD. The average transaction price in the last 3 months has hit 110 million.
As we mentioned earlier, we can clearly observe that these 3 major exchange-traded funds, ETFs, have actually experienced a significant net inflow of 6 billion HKD since the beginning of this year, demonstrating their appeal and continuously attracting funds from investors.
Retail investors also have the valuable opportunity to utilize ETFs for effectively deploying their capital in the Hong Kong stock market, which is clearly reflected in the recent capital flows.
Using exchange-traded funds, or ETFs, to invest in the Hong Kong or A-share markets is a strategic choice, particularly because the U.S. stock market has been experiencing numerous diverse news items recently, which can create volatility and uncertainty for investors looking for stability elsewhere.
Recently, various news outlets have reported that Donald Trump has made 2 notable statements within a single week, asserting that the Federal Reserve should consider cutting interest rates. This development has led to a heightened expectation within the financial market concerning potential interest rate cuts in the U.S., which in turn is resulting in greater volatility and fluctuations in the U.S. stock market as investors react to these changing economic indicators and anticipated policy shifts. Additionally, there is a significant issue where former President Donald Trump has mentioned plans to impose tariffs on specific industries such as automotive manufacturing and semiconductor production.
These economic policies could potentially drive significant inflationary pressures in the market.
Furthermore, there will be several potential uncertainty factors affecting the market landscape. At this moment, there is a widespread expectation of a significant reduction in holdings across various sectors.
However, how many times will there actually be a reduction in interest rates? Some financial experts speculate it might be just once, potentially a modest cut of 0.25 basis points. In this context, the investment outlook for the S&P 500 and the 3 major U.S. indices will be closely watched, as well as the overall impact of upcoming tariff policies and anticipated interest rate cuts. These factors are likely to significantly influence market volatility, creating both challenges and opportunities for investors navigating the landscape.
Oh, I have a positive outlook on the US stock market, but I think the volatility will remain high at least in the first and second quarters. The primary reason for this fluctuation is that market sentiment can change dramatically due to a variety of unknown factors, particularly in response to evolving political climates and international relations. These conditions create substantial uncertainty, which can lead to unpredictable shifts in investor behavior and market stability. Consequently, understanding these influences is crucial for making informed investment decisions. However, I firmly believe that this time it has the potential to recover its previous positive trends, particularly the stock indices, as they reflect the overall health and performance of the US economy, with a significant weight being placed primarily on the technology sector stocks. This observation also indicates that the lifeblood of the American economy is fundamentally derived from technology, which serves as a crucial factor and key element. I believe we have begun to identify a bottom in the market trends, and it's noteworthy that the US stock market has been performing positively for several consecutive days, suggesting a potential recovery. This uptick in performance could signal renewed investor confidence and optimism about future growth, particularly within the tech sector, which plays a vital role in driving economic progress.
Especially on the last trading day, several tech stocks have begun to recover in price, indicating a potential positive trend. If this situation continues, I recall that 6 months ago, Casta mentioned that the index was at 3195, largely due to market activities in Hong Kong impacting stock performance.
Currently, this is the sole trading account available in Hong Kong that permits investment in an S&P 500 ETF, providing a unique opportunity for local investors to access this popular fund. It's been quite a long time since we last analyzed this, and now with the current market situation being so dynamic, the historical data of the S&P 500 indicates that following a pullback, the long-term returns can be remarkably significant. We have been diligently looking into this trend and its implications for investors, taking into account various factors that could influence future performance. Understanding these patterns can help guide our investment strategies moving forward.
Recently, we have indeed seen a pullback in the US stock market over the past week or two. Looking back at historical data, the S&P 500 index typically experiences an average of 1 to 2 significant adjustments of over 10% each year, highlighting its volatility and market fluctuations. Last week, there was a significant 10% adjustment in the market, but in the last 2 days, it has started to show signs of recovery. Therefore, we young investors believe that the US stock market and the S&P 500 index can still provide strong long-term returns. Additionally, looking back at the Federal Reserve's recent stance, they have consistently maintained interest rates at their current levels. However, some dovish comments from officials have unexpectedly spurred a notable rebound in the US stock market. Therefore, we at Seng Investment firmly believe that the current fears surrounding stagflation in the US economy are somewhat overstated and may not reflect the underlying economic realities. Of course, the US stock market remains highly dependent on economic and financial data.
We firmly believe that the recent comments made by Powell are actually playing a significant role in stabilizing investor sentiment and confidence. This positive shift has contributed to a slight rebound in the S&P 500 index over the past week, reflecting increased market optimism. Furthermore, Trump's administration's policies aimed at significantly lowering corporate tax rates and easing financial regulations are anticipated to provide substantial support for the overall performance of the US stock market during the second half of the year.
On average, there are about 2 special periods each year. Seizing the opportunity may be a viable approach.
That's a good point, but I would also like to ask both of you. The U.S. stock market comprises 3 major indices. In addition to the S&P 500, there's also the NASDAQ and the Dow Jones Industrial Average. Why do you think the S&P 500 is particularly significant in this context?
Which option offers greater benefits or advantages?
For example, the 3 major indices are the 3 indices used by Hong Kong's media. In fact, investors have many different indices that are quite representative. We can discuss this in detail later. The S&P 500 index is definitely one of the most important indices because it has many constituent stocks. It continuously updates its constituent stocks, accurately reflecting the current local economic situation and market conditions. The Nasdaq Stock Exchange is primarily focused on trading larger technology stocks and companies.
Yes.
To elaborate further, the US stock market comprises 3 major indices, each showcasing unique strengths and characteristics in measuring performance.
If we take a quick look, the market capitalization and trading volume of the S&P 500 index are higher than the other 2 indices. Of course, when investing, aside from seeking returns, one should also consider risk. Therefore, you can see that the maximum drawdown of the S&P 500 index over 5 years is relatively lower than the other 2 indices. The main reason is that it is well diversified with 500 constituent stocks. This includes finance, industry, technology, consumer goods, and more.
In light of these increasingly volatile market conditions, while certain assets may exhibit aggressive growth potential, it is equally crucial to identify and utilize appropriate defensive investment tools as safeguards. The S&P 500 index can play a significant role in achieving that balance, offering a diversified approach to managing risk while seeking returns.
Just now, we highlighted that $31.95 is currently the only option available in the market, specifically in Hong Kong, which can be purchased through a trading account. But for potential investors, what specific advantages does 3.95 offer? The key points are that it boasts 4 significant advantages that make it stand out.
We firmly believe that the small cap stocks within the US market are quite strong and resilient, and the S&P 500 index also has notable advantages. Secondly, this ETF is the only S&P 500 index ETF in Hong Kong. So everyone can trade during Hong Kong trading hours, and it's quite convenient to engage with the US market and the S&P 500 index. Lastly, this ETF has a trading counter in HKD, allowing everyone to trade US stocks using Hong Kong dollars.
Expanding and enhancing the original text while keeping it concise. This strategic decision can effectively reduce certain foreign exchange costs. As a result, when all market participants concentrate their efforts on the Hong Kong market, they eliminate the necessity to convert currencies. This, in turn, helps them avoid incurring additional fees charged by banks for currency exchanges, ultimately leading to more efficient and cost-effective trading practices.
In the ever-evolving world of stocks, numerous significant events have occurred recently. Coming up soon on April 7th, there will be an exciting launch of a new ETF, which will introduce a variety of innovative financial products to investors.
April 7th, that's right. This upcoming ETF will specifically focus on high-yield investment themes that Hong Kong investors are particularly interested in, especially in light of recent market trends and developments.
It won't be a loss-making investment. I always look for income-generating opportunities, wanting to learn how to make money work for me, the snowball effect.
This ETF not only offers high yields that can attract investors, but it also pays dividends on a monthly basis, allowing everyone to look forward to regular income. Yes, it will distribute cash payments directly, not just reinvested NDV. It will provide cash.
Oh, you can definitely explain all the details later?
Sure.
We can eagerly look forward to mid-April when we will be inviting Casta to return and engage in a discussion about the highly anticipated high-yield ETF that is set to launch on April 7th. This informative segment is now drawing to a close as we prepare for that exciting conversation.
But everyone, please don't go away just yet because we are excited to invite Ryan to continue sharing valuable insights about the latest trends in both the Hong Kong market and the US market. We'll see you all again shortly. Bye for now.
Hi everyone, we're back. Yes, we're back like this.
I would like to add that yes, you mentioned the reasons why we should analyze the S&P 500 index. Personally, I prefer focusing on the S&P. When examining the performance of the Dow Jones Industrial Average, it's important to note that we often focus on this index in America. It's common to hear discussions centered around the Dow, as many people tend to refer to it this way. This is largely due to the fact that the calculation of the Dow is unique. Its overall weighting is determined specifically by the prices of the individual stocks included in the index. It actually consists of the 30 largest priced stocks in the United States stock market, reflecting significant companies. So this S&P 500 index, its weighting is somewhat similar to our Seng index, and it has 500 stocks compared to 30, so it's more diversified, yes. So usually in the US or when I buy ETFs, I like to choose some S&P 500 index ETFs. However, I want to wait until Casa leaves before I discuss this matter in order to avoid it sounding like I am simply advertising. The show is not that great, but I genuinely believe it has potential. The only reason I was previously trading Dow futures is due to its significant volatility, which can present lucrative opportunities for traders. When you engage in trading stocks, you find yourself frequently trading. Therefore, I concentrate primarily on that aspect since I don't possess the energy to trade across all markets. The S&P 500 index includes 500 stocks, resulting in lower volatility. Higher volatility is preferred when trading stocks. Yes, there are different ways to play.
Well, it seems that Casta has returned to the company, but are we still not back to work yet?
I assumed she went to complete her work, didn't she?
So we can certainly delve into our market discussion today. I have two specific topics that I would like to address with you if we have the time and opportunity for discussion.
First, let's talk about PopMart, identified by the stock code 9992. As you may know, it originally gained popularity by offering blind boxes, right? Yes, it indeed started with those intriguing blind boxes, and then it expanded its offerings due to the success it experienced.
It announced its financial results, revealing that for the last fiscal year, the total revenue attributable to shareholders reached an impressive 3.125 billion yuan, marking a remarkable year-on-year increase of 1.89 times. So this, I'll gladly give it all to you, okay? I seem to forget. Sorry, excuse me. Oh, it's your fault.
The basic earnings per share amount to 3.6 cents, while the declared dividend stands at 81.46 cents per share for the fiscal period.
Additionally, the revenue for the period is 130.3 billion, a year-on-year increase of 1.07 times. The mainland business is quite impressive, with revenue of 7.972 billion, up 52.29%. The revenue from Hong Kong, Macau, Taiwan, and overseas is 5.066 billion, increasing 3.75 times.
Among these figures, specifically regarding intellectual property IP, their allocated quota amounts to 12.722 billion, which represents a remarkable year-on-year increase of 1.17 times compared to the previous period.
Speaking of this intriguing topic, I want to mention the much-discussed show called The Monster. One of my colleagues sent me a captivating photo yesterday claiming it's a hit series that everyone is raving about. Why is it generating so much buzz?
With the popular Monster series, the company typically restocks items frequently, making them relatively accessible. However, since Lisa significantly boosted the Labubu product's popularity, the demand for the entire Monster series surged dramatically. Following Evan's release of the series, it sold out almost instantly, leaving many eager fans unable to wait for the anticipated restocks, which in turn drove prices up significantly.
Oh, so it's selling for over 1,000, even 2,000. But the issue is that the Doll Monster is the biggest contributor, with revenue reaching 3.041 billion, skyrocketing 7.27 times. There are also various other IP revenues that we can examine and analyze more slowly.
Just out of curiosity, where's Bobo?
Oh, it's Monster. Yes, I'm talking about Monster.
Hey, this impressive performance indicates that, if I'm not mistaken, it corresponds to the month of December. Actually, December is quite slow in terms of activity, not really a huge hit just yet for events and engagements. What does Queen Baby mean? Oh, it's IP.
I know, feeling chubby and crying like that is tough.
If you recognize it, go ahead. Otherwise, like me, you don't. So you, just like me, are unable to read it. Yeah. In December, it amounts to 1.1 billion, accounting for 10. Yes, please take a moment to look at our performance report displayed prominently here. It's intentionally larger because I'm concerned that everyone may struggle to see it clearly on their phones. As you can see, baby, its total revenue is 1.164 billion, while Monster Monza shows 3.04 billion. Therefore, it only accounts for less than half of the total revenue displayed. Its growth potential is significantly large. Now, this is the very first point that I want to emphasize. The second point is that if everyone has been paying close attention to our live broadcasts, they are already aware that I've always been supportive of this particular PopMart venture. Yes, this PopMart that I am referring to was valued around 99.92 back when its price was just a few $dozen. A small amount of money is overdue. Why do I say that? Because there is a clear trend. Its overseas revenue is growing very rapidly, and the proportion is also quite high. It used to be just in the mainland. It's difficult to grasp the mainland market, and isolating ourselves limits our chances of survival. But if you can also play overseas, there is indeed income, including places like Thailand, which also have significant revenue. So your whole business becomes stable. This is the first point. The second point is that in the Hong Kong stock market, there is actually no other stock like this. Some people used to say, when everyone was speculating that these are IP stocks, we would take some IPs to make product shares, but actually they can't be compared. For instance, the newly listed stocks, such as Blueco, are referred to as superhero stocks because they creatively leverage superhero intellectual property, IP, to develop innovative products alongside Miniso. These well-known IPs sell these products, but this profit model cannot be compared to 1992. The real stocks that benefit from what we call the stock market economy are truly those in the vertical industry chain. So now you can easily imagine that the upcoming performance will gradually reveal the intriguing effects brought about by other intellectual properties, such as the charming character Quite Baby and so on. To be honest, when it comes to Monica, I must say, I can't really assess how popular it is. I only see the numbers, which don't tell the whole story.
I mean, you can certainly discuss it factually, using relevant user data and presenting it rationally. So, did you actually end up buying it?
Just speaking, I have a strong dislike for Crayon Shin-chan.
Why? I find it truly disgusting, with those fuzzy, unappealing things and the jagged, sharp teeth that make me feel uneasy.
Yes, and I know a few of my colleagues working in Shenzhen who really enjoy it.
They say you can't even buy it. You have to join a fan group to get a crayon Shinchan, and do you have to pay inflated prices to join the fan group?
No, but they will definitely notify you quickly, urging you to hurry up and buy it, so rush to grab it.
Otherwise, you'll have to pay the inflated price. And then, regarding external marketing, yes, I sent a message to my colleagues in Shenzhen yesterday to apologize.
I said I really shouldn't speak so definitively. What did you say?
Yes, I truly dislike it. In my opinion, it's utterly disgusting. You can also choose to dislike it now if you wish. I want to share a story about my husband attending another event, and at yesterday's event, they surprisingly gave him a crayon Shinchan toy, which I found quite amusing and unexpected.
So he handed me a Labobo, and I truly disliked it at first glance. However, then he explained that you can actually purchase various clothes online and easily exchange them for it, which suddenly made the idea seem quite cute and appealing. I started to appreciate it more after understanding its potential.
After he mentioned that to me, I immediately went on Taobao and also searched online to see how various people creatively styled a Lululemon shirt.
Suddenly, I discovered that the Lululemon apparel was quite appealing to me, and I sincerely apologize to my colleague in Shenzhen.
I truly shouldn't have mentioned that. Earlier today, I happened to glance at the financial report, which revealed that Monster is strategically shifting its focus toward these popular, trendy collectibles and models that are gaining significant attention in the market. This transformation could have substantial implications for their brand and consumer engagement moving forward.
They can strategically pair these stylish outfits with a variety of plush accessories, which can effectively attract a larger and more loyal customer base. However, it's important to note that this isn't where they primarily generate their revenue. Rather, it's more about enhancing and supporting their overall business model and the diverse range of products they offer. This approach not only builds brand loyalty, but also creates a more compelling shopping experience for customers, encouraging repeat visits and long-term engagement with the brand.
They can't generate substantial profit from peripheral products unless they possess something with genuine intellectual property. For instance, you often see individuals proudly wearing luxury brands such as Chanel, which carry significant brand recognition and value. This highlights the importance of strong IP in creating successful product lines.
Of course, these items are simply purchased from 1998's various stores. These items may not be official products from the prestigious Chanel group, but they certainly contribute to enhancing customer loyalty and satisfaction among their dedicated fan base.
But I would like to extend this intriguing thought further. Since they have the ability to exchange clothes, could they perhaps collaborate to create an entire complete set of clothing, just like the elaborate and stylish designs from the old days?
You have so many exciting options available, so why not buy them all?
From a female perspective, if you decide to buy a stylish accessory like a chic bag, I wore a beautiful blue one yesterday that I absolutely loved.
I mean, you can change the style without needing to swap it for a toy, but for a shirt.
I just wanted to share that I bought this stylish Labobo yesterday, and it's a vibrant shade of blue. If it were to wear a bright pink shirt, it definitely wouldn't look good and might clash terribly with its beautiful color.
So your approach would be to purchase a stylish pink Labobo to perfectly match the vibrant shirts you have.
And indeed, some enthusiastic individuals have purchased a series of Labobo in various colors specifically to match their favorite shirts, which certainly makes sense. And the lining.
The people I know from grouping here generally tend to ignore what I say. They often ask me, what exactly is this doing? They don't even know whether people genuinely like it or if your daughter actually enjoys it. Fortunately, your daughter doesn't care for it, haha. People often express opinions like that, but I believe in Gundam it's quite similar. Different professionals bring unique vibes and perspectives to the table.
But hey, regarding the grandma's recent purchase, there's another important thing I want to mention. Her impressive gross margin stands at 66.8%, which reflects a notable increase of 5.5% year on year. That's quite reasonable.
Absolutely. What are your thoughts on this particular aspect of the situation? Given that the gross margin has shown noticeable improvement, there surely must be some potential for further enhancements, correct?
Well, can't we just sell it for a higher price?
Actually, she definitely possesses that remarkable capability.
Sell the IP for a higher price? I often find myself asking, why should we pay attention to the Bubble Motor and other similar IP console stocks? The answer lies in the fact that these companies not only possess the complete intellectual property, but also maintain full control over it, which can lead to significant advantages in the market. But if you're just using the Superman IP to make your own products, you have no control. You're at the mercy of others.
Yes, that indeed is the key difference. So do you think there is definitely room for improvement?
Absolutely. What is the most concerning aspect or issue?
The biggest fear is that their IP won't be wanted. That situation shouldn't occur. It's quite evident that they have clearly demonstrated their impressive marketing skills.
It's true that IPs don't sell because they're pretty or not, but because they know how to market.
Is this a hunger marketing strategy?
Hey, I completely understand that's part of it, I'll say. Well, to be completely honest, I create a beautiful painting and carefully market it to potential buyers, then wait to see if anyone decides to purchase it. If no one buys it, I release a music CD to promote, and still no one buys it. To truly understand how to play the game, you need to consider several factors that come together, much like how people discover Becking and Lisa. If they choose to buy Lisa this time, will they still search for her in future games? Perhaps not.
So we can also take a closer look at the buying patterns. Additionally, I have another stock that I would like to discuss with you, which is JD. Let me begin by mentioning that it's clear you tend to use PowerPoint less frequently, correct? This is important because I don't want to overwhelm you with detailed presentations about their performance and financial metrics.
Okay, so what's that?
Are you looking at the performance?
However, even 3 sixes are indeed sufficient to make an impact. What I want to convey is that JD, the prominent e-commerce company, announced yesterday their intention to directly challenge our local electronics retailers in Hong Kong. They are planning to invest millions of dollars to promote a new buying pattern that essentially guarantees if customers purchase items at a higher price, JD will provide compensation for the difference. This strategy is likely to disrupt the market and significantly affect local competitors. You know, JD now has a prominent building located in the bustling area of Huaqiangbei, and everything you find there is intricately related to JD. All the various products you purchase from this location are directly connected to JD's extensive network. Recently, in the lively Mong Kok area of Hong Kong, eye-catching JD advertisements have already been set up, further enhancing their brand presence in that vibrant market. In Broadway, conveniently located next to Fortress, they proudly claim to offer lower prices and exceptional after-sales service. You can easily make a price comparison across various stores in Hong Kong to see for yourself. Furthermore, if you happen to purchase an item at a higher price elsewhere, they guarantee to refund you the difference, and in a remarkable offer, they will even double that amount. This makes shopping with them an enticing proposition for savvy consumers. Sorry, I mean, it's not doubled back to you, but if you buy at a higher price, the difference will be compensated in the form of coupons, which means they will actually refund you the difference.
Oh, so that's how it is. If they decide to make another purchase, haha, they're just prolonging the process. Additionally, if you're a brand new user, you can take advantage of a special coupon valued at 600 yuan, which is quite a generous offer. Some of the appliances available for purchase come with the added benefit of free shipping and a convenient 30-day return policy. Recently, they have launched this exciting new product. Earlier in our conversation, you pointed out that logistics poses a significant concern for JD, correct? Could you elaborate on the reasons behind that concern?
What did I say?
You mentioned that the primary concerns were related to the cost issue, the financial constraints, and the challenges within the logistics chain. But I want to say that in Hong Kong, besides this unique buy at a higher price and get compensated promotion that has caught everyone's attention,
JD Express has recently opened a brand new operation station in Chai Wan on Hong Kong Island, which encompasses a substantial area of 10,000 square feet. This new facility marks a significant change in their logistics delivery method. Previously, once a product arrived at the station, the process was more cumbersome, but now it promises to enhance efficiency and streamline operations to better serve customers in the region.
the courier would carefully and manually select the items destined for their specific delivery area, and then those items would proceed for logistics transport to reach their final destination.
In the past, JD's logistics method was somewhat traditional and manual, but now they are significantly enhancing their operations by adding advanced automated sorting equipment. For example, the new system is capable of accurately sensing whether a specific package is destined for Wanchai or Chunwan, which greatly simplifies and streamlines the entire distribution process. They anticipate that this technological upgrade will result in a doubling of overall efficiency. What do you think this development means for JD and its future in the logistics industry?
Because we've previously pointed out that logistics operations often encounter several significant bottlenecks that can hinder efficiency and progress.
We've talked about it before. Do you know why?
Well, if I recall correctly, it's primarily about the significant cost associated with logistics.
It's actually about warehousing costs. To be precise, has this issue been resolved? Not really. Yeah, that's right. It has improved logistics efficiency, but it hasn't solved the overall operational model issue.
So what's the main difference between JD's operational model and Alibaba's approach? Alibaba has established a comprehensive online platform and created a virtual store. When you enter this store, you simply say, I want to buy a towel, and you can browse various options available for purchase. The staff will present you with the comprehensive towel catalog featuring a variety of designs and colors, and then you can easily place an order, after which the selected towel will be promptly sent directly to your address. This is the Alibaba model, where you browse online at your convenience. In contrast, the JD model involves physically walking into their store and expressing your desire, saying, I want to buy a towel. Following this, JD will guide you to view the various towels that are neatly displayed in their store for your consideration.
The primary issue at hand is that the company incurs significant inventory costs, which ultimately contribute to their overall expenses. And it is important to recognize that holding inventory represents a financial burden. Managing these costs effectively is crucial for the business's profitability and sustainability. Thus, inventory management becomes a vital part of their operational strategy. Yes, and because of these factors, JD Hong Kong's promotional offers clearly indicate that they are facing several specific challenges, such as the rising cost of rent and labor, which they unfortunately have to pass on to you, the consumer, in order to maintain their operations and continue providing their services. I would like to inform everyone that JD Hong Kong also operates warehouses, which incur various costs. Although they do not have traditional physical retail stores, they do possess some warehouse space for their operations, which helps facilitate their logistics and distribution processes. Yes. Honestly, JD and several other companies, particularly those located in mainland China, have logistics operations that function with remarkable efficiency. In contrast, the general warehouses in Hong Kong are often unable to adequately meet the diverse and specific needs that these companies require for seamless operations. This discrepancy highlights the logistical challenges faced in the region. They need to effectively utilize many advanced robots and automated setups to improve efficiency and streamline their operations. Hong Kong's warehouses tend to be quite traditional in design and function, with many primarily focused on simply storing various goods. Additionally, they frequently encounter significant challenges related to limited space, which can hinder operational efficiency and the ability to meet growing demand. Facilities may lack requirements for fire, water safety, and ground flatness. This implies that whenever you are required to fulfill these specific requirements, the associated costs will inevitably rise as well. However, of course, this situation is limited to Hong Kong. JD is such a massive player. Can they effectively capture the Hong Kong market? No problem at all, as they possess billions of dollars in cash reserves. Currently, they are effectively giving away money in order to eliminate some retail competitors from the market. This strategy seems aimed at consolidating their dominance by undercutting prices and making it challenging for smaller businesses to compete effectively. However, in the long run, is this truly a sustainable and healthy operating model? Not necessarily so. Reflecting on JD's performance, in 2024, which was last year, they achieved an impressive revenue of 1,158.8 billion in business. They earned what amount? 413 billion. Yes, they are a company that earns hundreds of billions, but the profit margin is only about 3%, meaning for every 100 yuan in business, they pocket just 3 yuan. Right, so you have a positive cash flow, but the problem is that the actual money booked in accounts is relatively quite low. This particular operational model is not something I genuinely like to see or support in any way, as it raises several concerns.
However, if we discuss this topic further, their expectation is to strategically plan a building that closely resembles the iconic Huaqiang Bay in Hong Kong. To effectively further expand their business operations, do you believe that this point, aside from the existing logistics challenges, is not particularly impressive enough to positively influence people's attitudes towards them? It's crucial to emphasize that their core problem lies not within logistics, but perhaps in other areas that require attention and improvement. This distinction should be clearly reiterated to ensure better understanding.
It's primarily about the operational model. Indeed, their specific operational model makes them highly reliant on efficient logistics for success. Yes, they are very dependent on logistics, and they are known for being fast. When you order from JD, it arrives quickly. But this comes from their operational model. You need to have goods in the warehouse first. They are a well-established store, so transactions are naturally quick and efficient. If you go to the market to buy groceries, it's a fast experience, definitely faster than the often time-consuming online shopping process. Therefore, there's no pressing need to go through the digital platform for purchasing. However, in the investment world, we need to carefully evaluate if their operational model can truly generate sustainable profits and revenue over time.
Clearly, it is evident that their business model is unlikely to change anytime soon. It simply will not.
They may unknowingly sell counterfeit goods while incurring losses. Counterfeit goods are curious and puzzling. Hey, I heard you have a warehouse, right? It's quite challenging for me to thoroughly test some of the goods you receive from your hands. For instance, if you buy items from JD and then visit an LV store, the experience and quality are not quite the same as dealing with grey market sellers in Hong Kong. The differences in authenticity and sourcing can be significant, making it important to understand where the products are coming from and how they are handled.
Not really, but in the past, if we had learned to speak using traditional methods, it was quite similar to how Taobao operates today.
For example, if I were to open a new shop, you still wouldn't know who I am.
I need to list my products on JD first. For instance, if Evan decides to buy a keyboard, that would be great.
So if you're loading a piano, just put your keyboards there, right?
You're currently loading a piano, but there are also a few small retailers in the area, right? A small retail store is definitely available too. However, if that is indeed the situation, it could potentially have a major and far-reaching impact on Hong Kong's retail industry as a whole. For instance, in recent developments, Meituan has successfully pushed out its competitor Foodpanda from the market, further consolidating its position and influence within the local food delivery sector. This shift could reshape the competitive landscape and affect various retail businesses in the region. And now in Hong Kong, there are talks of ride-hailing services like Didi, and who knows what will happen to Uber.
Like that. With the influx of substantial foreign and domestic capital into the vibrant market of Hong Kong, I find that I don't have strong opinions regarding the impact on our retail industry. As a consumer, my primary concern is simply to have access to fair pricing for quality goods and services that meet my expectations. I hope that this financial investment leads to a diverse selection and competitive pricing, ultimately benefiting consumers like myself in the long run. I mean, I won't tell you exactly how to survive in this situation. Honestly, for example, when it comes to purchasing glasses, many individuals prefer to buy them in Shenzhen. They often believe it is silly and too expensive to get them in Hong Kong, where prices can be significantly higher. This preference highlights the differences in cost of living and consumer choices between these two locations, which can influence where people decide to spend their money on everyday items like eyewear. But there are indeed numerous glasses available that do not come with any guarantee, and many of these are unfortunately counterfeit. I would say that a significant number are simply not genuine products. Some individuals even claim to be original, but they are actually certified. Similar to some phone lenses that are certified as original products, the L brand phone lenses are in fact not manufactured in Germany as one might expect. The lion head design is somewhat similar to that concept. When discussing eyewear, it's important to understand that the overall quality largely hinges on the expertise and skill of the optometrist, who possesses a professional qualification in this field. Their training and experience significantly influence the effectiveness of your prescription and the comfort of your glasses, ensuring that you receive the best possible vision correction. You can clearly see how much trust you have in your vision. Do you wear glasses by any chance? I do, and it's quite evident that you can easily tell the difference between a good pair and a bad pair of glasses, especially when it comes to complex lenses that require precise optics for clear sight. Complex lenses aren't solely focused on myopia. Introducing astigmatism significantly complicates the situation. Moreover, if you factor in presbyopia or similar visual issues, it compounds the complexity even further. This intricate nature is where the true value lies. Therefore, when we examine the competitive landscape of the retail industry, you simply cannot compete on price alone. You must also offer some distinct value. If consumers are willing to pay a higher price, you need to provide something additional or unique to create a viable space for your survival and success in the marketplace.
Many individuals are currently expressing hope for the number 1137, such as those associated with THA-TV, to persist in their endeavors and not become entangled in detrimental price wars that could harm their business. Because HKTV Mall still offers some unique products.
Oh, really?
Yes, I saw various people discussing this topic online.
But it seems that time has flown by remarkably quickly today, and we're almost at that bittersweet point where we must reluctantly say goodbye.
In the upcoming episode, we'll delve deeper and share additional insights and information about the U.S. stock market and its current trends. We will meet at the same time as usual, but it appears that we might start a bit earlier than before. To stay updated, please keep a close watch on our Instagram for any announcements or changes. Your engagement is important to us, and we look forward to connecting with you.
Or on our social media. We'll see you again next episode. Thank you all. Goodbye.